Hello and welcome to Market Brief After Hours. It was a fascinating end to the week on Wall Street, with records falling left and right. The narrative seems to be shifting yet again, with bad news regarding the economy somehow turning into good news for stock pickers.
That's exactly right. It's one of those classic counterintuitive market moments. We saw U.S. equities end the week on incredibly strong footing. We had fresh record closes across the major indices, and the catalyst was actually the December jobs report coming in softer than expected.
So the economy is slowing down and investors are celebrating.
Precisely. The data reinforced the view that the U.S. economy is slowing gradually, what we call a soft landing, rather than stalling out completely or crashing. That Goldilocks scenario encouraged a lot of risk-taking heading into the weekend. Buying was broad-based, with technology and housing stocks really leading the charge.
Let's get into the specific numbers because they were impressive. What did the scoreboard look like when the closing bell rang?
It was green across the board. The Dow Jones Industrial Average climbed 238 points, or 0.48%, to finish at a new closing high of 49,504. For the week, the Dow posted a gain of more than 2%.
And the S&P 500?
Another record there as well. The S&P 500 rose 0.65% to close at a fresh all-time high of 6,966. It also set a new intraday record during the session. The benchmark finished the week up more than 1%.
And I assume the Nasdaq joined the party.
It certainly did, actually outperforming the others. The Nasdaq Composite gained 0.81% to end the session at 23,671. That extended its weekly advance to nearly 2%. We are seeing persistent demand for technology stocks as investors balance resilient earnings prospects against the hope that monetary tightening won't be as aggressive in the near term.
You mentioned the jobs report was the trigger here. Let's dig into that data. What exactly did the Labor Department release?
So December non-farm payrolls increased by 50,000. That came in below expectations of 73,000 and was also down from the revised 56,000 in November. To give you some context on the cooling trend, payroll growth for all of 2025 has averaged just 49,000 jobs per month. Compare that to the 168,000 average we saw in 2024.
That is a sharp drop-off in hiring pace.
It is, but the unemployment rate actually edged lower to 4.4%, beating forecasts for 4.5%. So the labor market is cooling, but it's still resilient. It's not collapsing, which is why the market sees this as a green light for risk assets.
Let's hop across the Atlantic. Did this optimism spread to European markets?
It absolutely did. European equities advanced as investors there also weighed that U.S. economic data. The Pan-European Stock 600 index rose by nearly 1%, with most regional bourses in the green.
How did the major country indices fare?
In the UK, the FTSE 100 climbed 1.74% for the week to close at 10,125. In France, the CAC 40 surged 1.4% to a new record close of 8,362. That was driven largely by luxury brands and a strong rally in BNP Paribas.
And Germany?
The DAX in Germany added 0.50% to reach 25,252 points. We also saw Italy's FTSE MIB increase slightly to 45,724, and Switzerland's SMI reached a new record high, settling up 0.53% at 13,422.
It sounds like a global rally, mostly. What about Asia?
Asia was a bit more of a mixed picture. We saw a rally in defense stocks across the region due to ongoing geopolitical tensions. For instance, South Korean Hanwha Aerospace soared over 11%. But looking at the indices, Japan's Nikkei 225 was a standout, surging 1.61% to 51,940.
What drove Japan higher?
Fast retailing jumped over 7% following strong quarterly profits, which lifted the whole index. However, Australia's S&P ASX 200 edged slightly lower. Rio Tinto shares slid over 6% there after news broke of early-stage buyout talks with Glencore.
We're going to take a very short break. When we come back, we'll dive into the technicals on Forex, check in on commodities, and look at the individual stocks that made big moves today. Stay with us. Welcome back to Market Brief After Hours. Before the break, we covered the equity rally. Now let's look at commodities. Oil prices seem to be creeping up again.
They are. Markets are weighing potential supply disruptions linked to Iran and uncertainty surrounding Venezuelan output. Brent crude rose 1.04% to $63.03 per barrel, while WTI climbed 1.82% to $58.81. Both benchmarks were on track for weekly gains.
And what about the precious metals? Gold has been on a tear recently.
The bull trend is holding firm there. Gold closed at $4,507, up 0.67%. Technically, it looks very strong. The price remains well above the 50-day simple moving average at $4,220, the 100-day at $3,999, and the 200-day at $3,849.
Those moving averages really underscore the uptrend.
They do, and silver actually outperformed gold on a percentage basis. Silver surged 3.63% to settle at $79.77. It's trading sharply above its 50-day moving average of $60.15. As long as the price holds above $75.48, the upside momentum remains dominant.
Let's switch gears to the currency markets. I know a lot of our listeners watch the technical levels closely here. Let's start with the euro against the dollar.
The Euro USD is seeing some selling pressure. It closed at 1.1635, down 0.21%. The concern here is technical deterioration. The pair finished decisively below the 50-day SMA at 1.1642 and the 100-day SMA at 1.1664.
So breaking below those averages signals a bearish turn?
It does confirm a deterioration in near-term conditions. The focus is now shifting toward the 200-day SMA at 1.1566. That's a key medium-term support. A daily close below that level would raise the risk of a deeper pullback toward the 1.1500 area.
What about the British pound?
GBP USD is a bit more balanced. It ended at 1.3408, down 0.24%. It briefly dipped below the 100 and 200-day averages intraday, but managed to recover into the close. The rising 50-day SMA at 1.3291 continues to underpin the broader recovery structure we've seen since late October.
So for the pound, where are the lines in the sand?
Support is concentrated around 1.3369 to 1.3388. A sustained hold above that band favors stabilization.
Moving to the Canadian dollar, USD CAD.
This was a strong day for the US dollar against the loonie. USD CAD closed at 1.3909, up 0.38%. Crucially, the price pushed firmly above the 50-day SMA at 1.3808, the 100 at 1.3802, and the 200 at 1.3844.
Breaking all three averages in one move?
Essentially, yes. It signals a meaningful improvement in trend conditions following the December correction. The 1.4000 psychological level is now emerging as the next key target.
And finally, the yen. USD JPY has been rallying hard.
It extended that rally to fresh multi-year highs. USD JPY closed at 157.86, up 0.66%. The pair remains firmly supported above the 50-day SMA at 152.43. All the major averages are sloping higher, reinforcing the dominant uptrend. Resistance is now centered on the session high at 158.18.
All right, let's wrap up with the market movers, the specific stocks that grabbed headlines. You mentioned tech earlier. I assume semiconductors were involved?
Absolutely. Semiconductor stocks rebounded sharply. Investors rotated back into the sector after 2 days of declines. The VanEck Semiconductor ETF rebounded more than 2%. Specifically, Lam Research surged 8%, while ASML and Applied Materials each advanced 7%.
And there was some big news regarding Intel, correct?
Yes, Intel shares climbed nearly 11%. This came after positive comments from President Donald Trump following a meeting with Intel CEO Lip Bhutan. That political endorsement really fueled a sharp rally in the stock.
We also saw some movement in the energy sector, specifically nuclear power.
That's right. Nuclear power stocks surged on AI deals. Vistra jumped 11% and Oklo jumped 8%. They announced agreements to support the massive expanding power needs of artificial intelligence. It's a clear sign of how the AI narrative is impacting energy infrastructure.
Was there anyone who missed out on the rally?
Unfortunately, yes. WD-40 shares slid almost 7%. Their first quarter earnings per share came in at $1.28, which was down 8% from a year earlier. Even though they reaffirmed their 2026 guidance, the market punished the earnings miss.
So, to summarize, record highs in the U.S., a strong showing in Europe, cooling labor data, and a very distinct risk-on tone heading into next week.
That covers it. The markets are looking ahead, focusing on the trajectory of economic data and what it means for monetary policy. Right now, sentiment is supported by the belief that growth is slowing in an orderly manner.
A fascinating setup for the weeks to come. That brings us to the end of this episode. If you find this useful, please follow Market Brief After Hours on your preferred podcast platform. We'll catch you next week.